Welcome to this LSE public event hosted by the Department of Economic History in association with the Economic History Advisory Board. So today we are going to discuss with a panel of world experts what the history of finance can teach us about current issues regarding public debts in the new COVID-19 era. My name is Olivier Accominotti, and I am a professor at the LSE Economic History Department. This department brings together a wide range of economists, historians, and social scientists. And it is one of the world's leading research hub in economic history. And of course, we have strong expertise in several areas of economic history. One of them is the history of finance, a field which has experienced considerable growth over the last decade. Indeed, over the last 15 to 20 years, the world economy has been shaken by a series of unprecedented economic and financial crises, which have contributed to a complete reshuffle of the global financial order. And these events have also renewed interest in economic and financial history as policymakers, analysts, and stakeholders have looked into past events in order to find responses to the new questions which they struggle to analyze with conventional theoretical or empirical tools. The LSE, of course, has been part of this intellectual development. And to respond to this new interest, we are planning to expand in this area over the next few years. In September 2022, we will launch a new master's program in financial history. And students, as part of this program, will have the opportunity to take courses in both finance and financial and economic history. And this program will train students to analyze financial systems and policies through a historical and interdisciplinary approach, which will borrow from a broad range of social sciences. And I think today's event perfectly illustrates this approach. During the panel event, we will discuss how the history of finance can be useful to think about one of the most controversial topics in today's global economy, namely the management of high public debts. The 2008 global financial crisis and the COVID-19 crisis are these once-in-a-century events which have led to major shifts in fiscal and monetary policy. During the 2008 crisis and its aftermath, central banks have relied on creative methods, which we have come to call non-conventional policies, to prevent a breakdown of the global financial system and of the economy. At the same time, governments have engaged in fiscal stimulus to support economic activity. So these responses looked unparalleled at the time. However, they have since been outsized and outpaced by many times by the public authorities' response to the shock of the COVID-19 pandemic. And government's interventions in the economy have led to an explosion in public debts across both advanced and emerging market economies. Today, global public debt stands at almost 100% of global GDP. And a large share of the new public debt, which has been issued, especially in advanced economies during the pandemic, has been bought by central banks. And this situation, of course, has triggered concerns about the sustainability of these public debts, about the risks of inflation, and about the independence of central banks from governments. And just as we are talking, there's in fact a lot going on government debt markets. Investors who are uncertain about whether the higher inflation we are observing is just a transitory phenomenon or a permanent one. And they are also concerned about how central banks will react to this increase in inflation in the coming months. As a consequence, the yields on short-term government bonds in the US, in the UK, in Canada, in Australia have increased suddenly in the last week. And also, we've seen a rise in the long-term yield on Italian government bonds, which, of course, triggers worries about a return of the euro crisis. So there is much uncertainty about these issues. And in this context, turning back to history can be helpful, as it allows identifying relevant episodes of the past that can help us think about the challenges of the new era we live in. To what extent is the global public debt situation unprecedented? Have we experienced other periods of high public debts in history? How have governments and central banks in the past dealt with such high levels of public debts, and what have been the costs, as well as the broader economic, political, and social consequences? So to discuss these questions, we today have the chance to have an exceptional panel of experts in public debt issues and financial history. Our first speaker is Professor Carmen Reinhart. Carmen is Chief Economist and Vice President of the World Bank Group, and she is also on leave from Harvard Kennedy School, where she is the Minos Zambanakis Professor of the International Financial System. Her 2009 book, together with Ken Rogoff, entitled "This Time is Different: 8 Centuries of Financial Folly," is probably the most widely read book in economic and financial history. The book provides invaluable perspectives on the similarities and differences between various episodes of credit booms and financial crises across history. And it has been highly influential in academia, but also in the policy world and in the private sector. Our second speaker is Professor Graciela Kaminsky. Graciela is a professor of economics and international affairs at George Washington University's Elliott School of Public Policy, and she is one of the leading experts on financial crises in emerging markets. In particular, her empirical work on emerging market financial crises and capital flows in Latin America since the 19th century has been very influential, including on my own research on the global financial crisis of the 1930s. So I'm very pleased that Graciela could join us today. And finally, our third speaker is Professor Thomas Sargent. Tom is William Berkeley Professor of Economics and Business at New York University's Stern School of Business. He's one of the most influential and widely cited economists in the world, and was awarded the Nobel Prize in Economics in 2011 for his empirical research on cause and effect in the macroeconomy. Especially his work on rational expectations has contributed to reshape macroeconomic theory, as well as our understanding of the effects of monetary and fiscal policy. But Tom has also applied rational expectations theory to major historical episodes. For example, his application of the theory to the German hyperinflation and to the end of the hyperinflation is a classic study which has been part of LSE course reading list for years, as it profoundly changed the way economic historians think about this episode. So it is a big pleasure to have these three distinguished speakers on the panel today. And before we get into the discussion, let me say a few words about the practical organization of this event. So first of all, each speaker will make a short presentation of about 8 to 10 minutes, discussing what various episodes of financial history can teach us about today's policy challenges regarding public debts. And then we will have a discussion together, and the audience, of course, will have a chance to ask questions. So if you have any questions, please put them in the Q&A together with your name and affiliation, as we are especially keen to get questions from our students and alumni. So I will be able to see the questions, and then I will communicate them to our speakers. For those of you who are on Twitter, the hashtag for this event is LSE post-COVID, and this event can also be followed on Facebook live stream. It is also recorded and will be available as a podcast. Right. So that's it for the practical details, and I am now delighted to leave the floor to Carmen Reinhart, who will talk first about insights of financial history for today's public debt issues. So Carmen, over to you.
Thank you, Olivier, and hello to everyone. So before I speak to the issue of historic similarities or differences with the current situation, I think let me just take a couple of minutes to review, and I'll make references to how this fits into historic context, how public debt has been reduced in the past. What is the menu of options? I think it's a useful starting point to organize some of my thoughts. And first and foremost, I guess, when you have high debt to GDP, the first option, which is not really a policy per se, is you grow your way out of it. That is, of course, the highly desirable, that organically debt to GDP goes down as the denominator does better than the numerator. In other words, this is, I think, possibly the least controversial way of reducing the debt. Unfortunately, during periods of extended high indebtedness are seldom accompanied by very vibrant and sustained growth. So, and besides, growth is something that policymakers aspire to, but it's really difficult to see growth as a policy. So what are the tools? Well, the first one is the very orthodox tool of belt tightening, now called often austerity, but basically you reduce expenditures or you increase taxes, you sufficiently do this consistently so as to reduce the debt to GDP level over time. In none of these approaches that I discuss, there are silver bullets, and I will go back to historic context on this and how some of these policies were used. So belt tightening, austerity, whatever you want to call it, fiscal discipline, consistently apply. This is not about a 1 year off, not for high debt levels. The remaining menu of options are somewhat less orthodox, but nonetheless widely used. One is the use of the inflation tax. The central bank buys the government debt, the central bank monetizes the debt, ultimately inflation goes up. And if it is domestic currency debt, inflation, especially, but not exclusively, especially unanticipated inflation, will erode the nominal value of the debt stock. Inflation, first and foremost, has to be remembered, is a tax. So it is not a tax administered by the fiscal authorities, it is a tax administered by the central bank. So it is a taxation without representation. And I would note that it is a regressive tax at that, but we can discuss that later. So inflation has been also a feature of, and I highlight domestic currency, right? Because this is not an option to reduce external debt that is in a foreign currency. Then one that I've written, I'm still on the menu, but one that I've written quite a bit on, which is financial repression. I will go back to reference that. This was fairly widely used. I mean, financial repression historically has often been associated with emerging markets, but in effect, under the Bretton Woods system at the end of World War II, you had all manner of interest rate ceilings, capital controls, very tightly regulated financial markets, a very large footprint of the central bank in financial markets. So those are the very pillars of financial repression. And what can financial repression deliver? Usually the aim of financial repression is to deliver negative ex post real interest rates, which is negative ex post real interest rates deliver a transfer from borrowers, from savers to borrowers. It is a tax, also a tax on bondholders, or more broadly, a tax on savers. And this was, de facto in the 50s and 60s, a yet another method, less widely known than austerity and overall inflation, but nonetheless, another method of debt reduction. And last, and certainly not least, especially as you mentioned, Olivier, emerging markets, is debt restructuring. And debt restructuring can be used and has been used in effect. Most of the debt reduction episodes since World War II in emerging markets have involved debt restructuring. And this is, you can do debt restructuring on domestic debt. That is done. It is less frequent, but nonetheless, there are domestic debt restructurings and domestic and external, the more famous external debt restructuring, which basically can take the form of writing off part of nominal debt. It can take the form of extending maturities and reducing interest rates. But the bottom line is that there is a haircut, a write-off of some magnitude in the present value of debt. And so that is also a tax. And the tax this time falls on the creditors. Having said that, where are we now in terms of historic context? Well, if you just look at the debt numbers, I'm not making broad brush comparisons, but if you look at the debt numbers for the advanced economies, the debt levels, public debt levels, are very similar to those at the end of World War II. But let me say that is really a very narrow view of the subject, because at the end of World War II, public debt was the only game in town. Private debts had been really wiped out largely through during the Depression and also during World War II. So public debt was the whole 9 yards. Now we have record levels of private debt. Ostensibly, a big chunk of that is a contingent liability potentially for the government. So the level of indebtedness at the moment really is much more than what the seeming comparison to the end of World War II would suggest. Furthermore, at the end of World War II, the pension system was very limited. Now it's much more significant. So bottom line, there's a lot of off-balance sheet that isn't taken into account. That's advanced economies. And I'll conclude by saying that for emerging markets, the end of World War II is not a particularly compelling point of comparison. For emerging markets, what we're really seeing, and this is not seat of the pants, you actually do when you do the aggregation for external debt and public sector debt, what you see is something closer to what you had at the end of the 1970s, beginning of the 1980s, which of course ushered in the debt crisis of the 1980s. Now, does that mean that we are, expecting just on the basis of debt levels in emerging markets, another round of the 1980s? I'm not suggesting that, okay? I'm not suggesting that for the following reason. At the time in which Paul Volcker, in October of '79, tightened monetary policy in the US inflation was 14%, and real interest rates jumped to the highest level since the 1930s. This, of course, was a major external shock that hit the borrowing countries, the debtor countries. The odds of a tightening of that scale by central banks in the current environment is not something I attach a high probability to. However, despite the fact that I do think the the likelihood of a very adverse, very adverse external shock is unlikely, I do think the risks in emerging market at the end of COVID now have multiplied dramatically. And among low-income countries, it is not a hypothetical. Whether the Fed raises rates, keeps it the same, or decides to lower them, they're already in debt distress, many of them. If you take the 73 low-income countries that make up the debt service suspension initiative, more than half of them are already either in debt distress or at high risk of debt distress. So I'll conclude by saying for many low-income countries, they're really right now the canary in the coal mine. They're already in debt distress. Many emerging markets are in much riskier waters than they had been for a very long time. And advanced economies have more rope, but are also in riskier territory. And, do not confuse the fact that public debt levels today look a lot like they did at the end of the war, because the private debt issue and the pension funds and the contingent liability dimension is on a different scale altogether. And let me stop there.
Thank you so much, Carmen, for these remarks. I really like the classification of the different options that governments have to reduce public debts. I was thinking that the options that governments eventually choose very much depend on the political context and the political economy, right? So there is, you mentioned belt tightening and fiscal austerity as a possibility. There is at least one country in history which managed to reduce its public debt through fiscal adjustment, and this is the UK in the 19th century. Following the Napoleonic Wars, the UK debt level stood at around 200% of GDP, and then you had decades of primary fiscal surpluses in the UK, which eventually managed to bring the debt back to about 30% of GDP on the eve of World War I, right? So that worked. We don't, tell much about the cost of that policy. At the same time, you also have, recent experiences which seem to be unsuccessful. I'm thinking of Italy, for example, which has run primary fiscal surpluses since the mid-1990s and has not managed to reduce its public debt, right? So, I'm just thinking, what has changed here? And is it, possible, given the political context and the political economy, that that governments do what the UK did in the 19th century and engage in long periods of primary fiscal surpluses, or is that not an option anymore? I would love to hear your thoughts about that.
My own sense is that the odds of anything resembling what the UK did in the 19th century are limited. I would make a couple of observations on the debt reduction by the UK. One is it was very gradual. It was very gradual. If you look at debt reduction, it took almost a century. From the Napoleonic Wars to World War I, it was gradual. Secondly, they had help. They had colonies, and there were significant treasure transfers from India to the UK, and so I would not underplay that. They're very different. And third, I would say, when a good chunk of that period, you have the gold standard, the issue of financing through large purchases by the central banks. In other words, monetization wasn't an option the way it is today. So I don't attach. The political economy issues that you raise are extremely important. And I would note that you don't have to look at the 19th century in the UK. At the end of World War II, the United States also tightened its belt significantly for an extended period of time. It was, I would argue, in the context of the political economy, much easier to do then than it is now. Importantly, if you look at expenditure, a large share of expenditures were discretionary. Many of them were related to the war. In other words, expenditure had a much more reversible component than it is today, when it's dominated by transfers, which are much more sensitive, much more difficult to reduce. So I do think that if budget balancing is attempted, my expectation is that it will have a very active revenue component, since unlike at the end of World War II, there's a much stickier dimension to the expenditure side. But I'll conclude by saying that I also would argue that since 2008, 2009, and I wrote the papers on financial repression with Belén Sprancia in 2010, 11, that the financial repression, in other words, interest rates that are below what otherwise would have prevailed, have been a contributor, not, we can't really say to debt reduction, but to keeping interest burdens below what they would have been, and therefore, they played a role, not a dominant role, but they've already been playing a role, and I think they will continue to play a role. And we'll also see about inflation. You mentioned Italy, and I'll stop there. Never rule out debt restructuring. Okay, in 2010, before the Greek debt restructuring, I had highlighted at that time that debt restructuring was also something pre-World War II that advanced economies did, not as frequently perhaps as some of the emerging markets, but debt restructuring was certainly not unheard of in the 19th century. And when other options become more limited, one has to look at the whole menu.
Yeah, no, that makes sense. Yeah, and so you mentioned the fact that financial repression leads to negative real interest rates. And of course, we live in a world where real interest rates have been negative in many countries for several years. So would you characterize the period we live in as a period of financial repression in advanced economies? Or do these negative real interest rates have other causes, right? One cause could be just risk aversion, the fact that there is a shortage of safe assets, so a huge demand for advanced economies, governments, bonds, which also drive real interest rates on government debt down. Or, is it linked to banking regulation? And can we distinguish between banking regulation and financial repression? So what are your thoughts here about the difference in the causes of real interest rates being negative today versus after the Second World War?
So I would first and foremost have to say that the idea of that the exceptionally low and exceptionally long extended periods, this is a departure from history, in order of magnitude and persistence of negative real interest rates collectively in the advanced economies, it would be difficult to argue that this is all about financial repression. I think the productivity issues, the balance, we had the issue of shortage of assets, it's, safe assets. It's, I'm not ready to embrace that quite in that form. I mean, you had since the early 2000s, the growth of China and their huge purchases of U.S. securities with very large saving rates, so I would characterize it as something that, is importantly connected to that. But clearly, demographics, there's a lot of other factors one can list on why rates are low. However, it cannot be denied that if you look at, and happy to share the data, I presented this at the Carl Brunner lecture last month. If you look at government security holdings across the advanced economies, across each advanced economy, central bank holdings and government securities take a big ratchet up in around the 2008-2009 crisis. They never normalize. They take an even bigger ratchet up during the COVID crisis. The footprint of central banks is on a scale that I am not familiar with in peacetime. Maybe, I stand to be corrected, but I'm not familiar with such a large scale footprint. Financial repression is not just about the size of the balance sheet of the central bank and the role, but it's also importantly connected to regulation. So to your very insightful question of, can we separate financial repression from regulation? The answer is usually no, it's very difficult. And what we also saw at the end of 2008, 2009 is a variety of policies across the advanced economies that required or induced financial institutions to buy more government securities, to hold larger shares of government securities, which of course, in the old jargon of financial repression, it's great to create captive audiences. So, but all I'm saying is, while many other factors have influenced where we are in real interest rates, monetary policy and regulatory policy under the unintended umbrella of financial repression or unlabeled umbrella of financial repression has played, I think, to this day, a very important role.
Good, thank you, that's very insightful. So I'm gonna hand it over to Graciela. I'm sure we'll have more questions about this issue of financial repression in the Q&A. For now, I'm gonna hand it over to Graciela, who I think will talk about the sovereign debt crisis of 1825 in Latin American countries. So please go ahead, Graciela. Thanks.
Can you see? Can you see the presentation? Okay. Today I'm going to expand a little bit what I told Olivier of the crisis that I was going to be looking at. And when you look at Latin America, you can extend over 200 years and have a plethora of financial crises. I'm just going to focus on two of them, and then I would like to look at the issue of what is happening now with COVID-19 and Latin American countries and what it tells us, what happened before, how different factors are going to perhaps replay. Okay. Latin America started to participate in international capital markets early on in the 19th century after getting independence from the Iberican countries. Latin America opened up to trade, to international trade, and also started to participate in international capital markets. So I'm going to talk about the first episode of crisis in Latin America that occurred in the 1820s. And this crisis was preceded by an international capital flow bonanza with London at the epicenter of financial issues. So I'm going to talk a little bit about that this bonanza ended with the 1825 London panic, and this crisis spread to Europe and Latin America. We are going to see that at the end of this crisis, well, first the countries defaulted, and there were a dramatic reduction of the debt that occurred at the end of all these defaults. The next crisis that I'm going to look, although we have many crises in between, is the 1980s crisis. Again, it occurred during a period of financial globalization. Again, this crisis has some similarity with the 1820 crisis in Latin America. And it was also preceded by a bonanza in international capital flows, this time with the United States at its epicenter. This bonanza lasted from the mid-1970s to the early 1980s. And as Carmen mentioned, this bonanza ended with the Volcker shock, when interest rates sharply increased to the 2 digits in the United States. And this triggered a really bad shock to emerging markets, to debtor economies, because at that time, the instruments that were being used were syndicated loans, and syndicated loans had a floating interest rate. And when the interest rates in the United States increased dramatically, the cost of previous loans and new loans was dramatic, and Latin American countries had to default. As Latin American countries defaulted, this affected too the banking sector in the United States, not the banking sector as a whole, but the large commercial banking banks, and these that were heavily invested in Latin America. When these countries defaulted, there was a problem, a large fragility in the banking sector. So lending completely disappeared, and the crisis spread to most developing economies. And again, we see another episode of large defaults. So I would like to look a little bit at these two episodes of crisis. And I'm going to look at COVID-19 and Latin American fragilities. This is a different type of crisis. This crisis in Latin America and in the rest of the countries was not preceded by a capital flow bonanza. Nonetheless, we have lots of fragilities. Latin America was one of the regions that suffered the most with COVID-19 in 2020. And this triggers, okay, new policies are adopted. We are interested in looking at how COVID-19 affected the financial fragility of all these countries and what we can assess going now forwards. So I would like to look a little bit similarities and differences. Okay, so let me talk a little bit about the 1820s. The 1820s, as Carmen was saying, was the beginning of financial globalization. We have the war, the Napoleonic Wars, lots of fiscal expenses across all the belligerent countries. And as a result, when the war ended, okay, there were lots of savings to make. And as you mentioned, there has been a reduction of the debt of England ever since until, and that lasted, this decline in government debt that, as Carmen mentions, lasted for a long period of time. Of course, when there is no demand for borrowing, interest rates, the returns start to decline, and investors start to look for higher returns elsewhere. And we have higher returns elsewhere in an area of the world that got independence, and the expectations were that they were going to be higher returns because of commodities and other issues. So what you see following the collapse of the Napoleonic Wars is that investors in the financial centers started to search for very high returns, and then they start investing, among other countries, in Latin American countries. And there was a need in Latin America to borrow. You have to develop the country, but most of it, all the countries in Latin America were in the War of Independence vis-a-vis Spain. And the possibility of tapping international capital markets was very attractive. And let me show you, when you are looking at the increase in external debt in Latin America, is mostly increase in public debt. There were investments in mines, etc., with the ventures being issued, but the largest portion was the increase in public debt, starting from 1821, when Gran Colombia was the first to start tapping international capital markets, until 1825, when the panic in London burst. It's interesting to see that the numbers of leverage that these countries accumulated was quite high. So here you have the increase in debt from going from 1821 to 1825. And you can see that I'm using exports because at that time we didn't have any data on GDP, but you have you can still grasp how heavily indebted these countries became. For example, Colombia borrowed, the increase in debt relative to exports was about 6 times, okay? In the case of Mexico, the increase in debt relative to exports was 4 times, similarly to Peru. And even the countries that borrowed the less, basically the debt over exports was 200% of exports, twice the level of exports. So these countries were dramatically, the leverage of these countries increased dramatically. Of course, all the countries defaulted. The London panic spread not just to Latin America, but also to Europe. And the following 10 years, international liquidity disappeared, okay? So there was a collapse in economic activity in Europe. The demand for the products produced by Latin American countries declined, and the terms of trade deteriorated dramatically. And you can see here in the chart on the left that the years following this crisis were a long episode, protracted episode of decline in economic activity. So what you have in this graph on the left, in the bottom, is the growth of exports relative to the normal times. And what you can see here is that after the defaults and overall decline in economic activity in the rest of the world, the growth of the economy slowed down dramatically. Only in the 1840s, 1850s, economic activity started to surge. So all these type of episodes have long-lasting effects. The ability of the governments at that time to do expansionary fiscal policy, like many countries are doing right now, and monetary policy was out of the question. During the 19th century, we were in the gold standard. The ability to print money was not there. Although if you see here, when you're looking at Argentina, Argentina was not in the gold standard at that time. The peso was continuously depreciating, and inflation not to the levels that we are going to see in the 1980s, but the average level of inflation in Argentina was about, during these 30 years, was about almost 6% per year. The rest of the countries, you can see that mostly they had a deflation during these 30 years. So one issue that we can discuss is what could have happened if these countries have some legal fiscal space and they could have an easy monetary policy. Okay. Going now to the second episode of financial globalization that Carmen mentioned before. In the 1970s, the Bretton Woods system collapsed. And so countries could float their exchange rates, have independent monetary policy, and without the need of having capital controls. And so most of the countries started first from the developed countries, and then by Latin America, capital controls were abandoned. Okay, this episode was preceded by the oil shock, okay, and financial globalization allowed to reallocate the savings of some countries, and they ended in deposits in the US banks that then recycled those deposits to emerging economies. Again, what we have is in this, in the years before the crisis, what we observe also is a capital flow bonanza. Again, what you can see here in the top chart is the increase in debt over exports, the external debt over exports. I'm not looking at the domestic debt, was quite substantial too. And no wonder was Mexico the first to have problems, because the accumulation of debt, of public debt at that time, rose to about 250% of total exports. Other countries too, Argentina, Brazil, and Chile also had increased their debt, the burden, the international burden after this crisis. With economic activity, with the debt increasing, with interest rates dramatically increasing in Latin America, this led to a collapse in economic activity in Latin America. This was much more dramatic than the collapse in economic activity that we observed in the 1820s. The countries close up, they introduce controls, the fiscal policy became quite expansionary, and without capital controls, the countries in Latin America use monetary policy, and this led during the 1980s to, in many countries, hyperinflation, like the case of Brazil, Argentina, and Peru, in which the average inflation was about between 300 and 500% per year from 1981, 1993. But in general, even though in Chile, Colombia, Mexico, and Uruguay, the rate of inflation was much smaller, still what we observed, okay, that inflation was quite high. And as Carmen was mentioning, this is a big tax on developing countries. And it's really a very high tax on low-income households. And so this created a lot of poverty in Latin America. So this period was a period of high inflation. Capital controls hurt the economy because there were no restrictions on the fiscal and monetary policy that these countries were following. At the same time, what was going on was the restructuring of the debt, and until the restructuring was finally reached, these countries were had to pay there was increasing in interest rates, and so they have to pay more, and this even hurt Latin American countries. At the end, as you all know, there was the restructuring, and countries got about 30%. COVID really had a really adverse effect on economic activity. It was the area of the world that collapsed the most, okay? So now, government and the monetary authority try to, with more fiscal space than they had in previous years, wanted to reduce or to incentivize economic activity. And what you have here is that the government borrowing increased dramatically. This includes borrowing abroad and borrowing from banks and from the central bank. And so monetary and fiscal policy was much more smaller in the 1990s and the early 2000s. In 2020, this increased dramatically. So it's something that we started from a low debt over GDP ratio, but now the government has increased its fragilities and money growth has increased too. One issue that is important too is that part of this borrowing of the government is from borrowing from banks. If you look at 2019, most of the borrowing in those countries was from the private sector, the blue bars, whereas the central government was not borrowing as much from domestic banks. This changed dramatically in 2020, in which you see that there is a kind of crowding out effect from the government to the private sector when you're looking at lending from the banking sector. So this is just what I would like to say. So we had a very dramatic effect of COVID-19 in 2020. The economies collapsed. The governments around Latin America tried to use their fiscal space and have a more expansionary monetary policy. This might have, and most of the borrowing of the government was from banks. This reduced the ability of the private sector to borrow from the banking sector, and the increase in debt increased the sovereign risk of the governments. And what you can see when you look at the ratings of these countries have declined sharply. So what we need to see, and now we have a problem that we didn't have a bonanza before, but now there is a borrowing, and there is much borrowing from the private sector. And so now we can have a problem from the government that is borrowing both from the banks and from the rest of the world. And this can lead to a downgrade of these countries, and it could put in peril the banks, the domestic banks. So this could lead to more contractions that could be more severe and protracted. So thank you for letting me finish.
Thank you so much, Graciela. That was very, very interesting, and sorry to be rushing you, but we would like to hear Tom as well, and we have the time constraints, right? So I'm gonna hand it over to Tom now, and then I'm sure we'll have questions about your presentation as well in the following discussion. So Tom, over to you.
Yeah, as I mentioned to you, I was planning on the time restraints being respected. But so I do have to go to a class. So so let me just tell you what I was going to talk about, and it's kind of better. I'll put this up on my webpage within a week. So we're kind of pursuing the same themes that Carmen especially was talking about in a more restricted domain. We have this, my friend George and I have this paper, 3 World Wars, looking at fiscal monetary consequences. It's a provincial American point of view. And we're just going to look here's the 3 World Wars. I'll show you some pictures. Okay. We kind of do a consolidated government budget constraint. We do some measurement correctly. And the 3 World Wars, lots of similarity with respect to the monetary and fiscal things. Here's World War I, World War II, and here's COVID. Look at these, and we look at these numbers. The red are tax collections, the blues are expenditures. Think of a Barrow tax smoothing model. This is what we look at. We talk about how to measure these things, kind of give you a reader's guide, this paper. We give some pictures. There's the primary deficit. That's kind of what in the US, kind of look at the patterns. What pops out at you is, yeah, so at the beginning, COVID starting to look like World War I and World War II. One thing that you see, if you stare at this graph, what you'd see was wartime during expenditures rose a lot, but then they stayed higher permanently relative to their pre-war level. Same thing in World War I, World War II. Look how expenditures, there was a permanent rise in expenditures due to some of the forces Carmen was talking about. What's going to happen after COVID-19? Your guess is as good as mine. Here's the primary deficit. Here's a reader's guide. Then we spend a lot of time looking at who owns this debt. There's a picture for you. You can find it on my webpage. Then we do who owned these treasury debt. And then finally, we show you a bunch of Fed balance sheets. I'm kind of a Fed guy. You kind of stare at these and stare at this. We could stare at this for an hour. And then finally, here's a graph of the market value of U.S. debt. This stuff here at the end, things got complicated when the United States government, when the Fed starts paying interest on reserves. When it starts paying interest on reserves, excess reserves look like interest-bearing government debt. So how should it be accounted for? And we do some corrections. And then it I'll kind of conclude here, goes back to issues at the beginning of the founding of the Fed. Part of what the Fed has done with these excess reserves is it's bought treasuries, but part it's bought, real bills. It's bought private securities, Adam Smith's real bills, and that should be accounted for differently. And then finally, I'll kind of tell you a big criticism of our paper. We look at everything through a consolidated government budget constraint. But really in this day of excess reserves, should you be doing that? Should you deconsolidate and have a budget constraint for the central bank and for a separate one for the fiscal authorities and explicitly model their payments? And this is a big issue now in the Euro area. Marco Bassetto with a co-author has a paper called 40 budget constraints, not one consolidated for the Euro area. So in the interest of time and where I have to be 5 minutes ago, I'm just going to stop now. So thanks. This is a wonderful occasion.
Well, thank you so much, Tom. And yeah, sorry you have to leave early, but I hope you'll enjoy your class and you'll tell them a little bit about the merits of financial history as well. Bye. So I think Carmen wanted to intervene. No. Oh, okay. So I saw your hand was.
No, I was waving to Tom.
I see. Good. Well, I'm really glad that we could hear Tom as well, despite the time constraint, right? So we're now gonna have a more open discussion, and we'll I'll collect questions from the floor. I mean, from the audience. So please, if you have any question, to our speakers, put them in the Q&A, and I will communicate them to Carmen and Graciela. Right. So so far we have 2 questions in the Q&A. So I will start with those. I have a first question from Sam Hart, who is a LSE economic history alumni, right? And Sam is asking, to what extent are the world's major central banks more or less independent from their respective governments today than in the past? I think there is an advanced economy answer to that question, but also an emerging market economy answer. So it would be great to hear your perspectives on that, Carmen, and then Graciela.
So let me start with advanced economies. I think de jure central banks remain as independent as they were before the global financial crisis. I think de facto central banks are much, much more constrained on what they can do, or what they're willing to do, or what is politically feasible. And so I think there has been a loss of de facto central bank independence to react symmetrically to shocks. Let me explain symmetrically. If there's a need to ease because of an adverse shock, we have seen unprecedented response. First, during the global financial crisis, it was unprecedented peacetime response at that time. And now, superseding that, we've seen an even greater response to the COVID crisis. We have seen much more circumspect, limited policy reversal of the 2008-2009 crisis. There is an asymmetry, meaning the response to adverse shocks and easing is not matched by a similar response when it comes to tightening. And let me highlight some reasons why, but I would note that if you recall my remarks, I did preface them also by saying when it came to emerging markets, I was not expecting a Paul Volcker moment response from any of the advanced economy central banks anytime soon. But I alluded to some of the constraining factors. Constraining the ability of central banks, and again, de facto, not de jure, to tighten, is the fact that private debt, corporate debt is extremely high. In some cases, in some countries, at all-time highs, and it's skewed towards lower quality, meaning it's high-risk debt, very low-quality covenant. So for financial fragility reasons, central banks may be averse to a sudden tightening. Then, of course, there are asset markets. It used to be called the Greenspan put, then it became the Bernanke put, and now one can just call it the Fed put. And who wants to be the central bank governor that burst the bubble in the equity market? So I think, the potential pricking of the bubble is another constraining factor. Then there's the political economy that, Olivier, you were also alluding to. You have now a highly indebted government, and the issue of raising interest rates and raising debt servicing costs is not one that would go down well at the political dimension. In some countries, like Switzerland, for example, you even also are constrained, and this is not just Switzerland, it applies to Scandinavia, it applies to Australia and New Zealand in different degrees. There is a tendency to go with the herd, that if the ECB, the Fed, the BOJ are maintaining rates low, you're afraid of raising rates because of currency appreciation. So fear of floating, or more accurately, what Levy-Yayati and Sturzenegger called fear of appreciation. So I'll stop here by saying de facto, I think central banks are much, much more constrained than they have been during the heyday of central bank independence. And by the way, central bank independence, as a big new movement, so to speak, took hold when public debt in the advanced economies was around its lowest level since the end of World War II. This would be the early 80s. So let me stop there, and I'm sure Graciela will speak to the EMs.
Yeah, Graciela, it would be nice to have your perspective as well, right? After all, following the COVID-19 pandemic, emerging markets, central banks have for the first time engaged in quantitative easing, even though it's not comparable in size to what the Fed or the ECB has been doing, right? But how does that affect central bank independence compared to the past?
In the 1990s, there was a rush in Latin America to have much more independence of central banks. And there was a sharp decline of inflation. The monetary authorities gained some type of autonomy to now intervene much more heavily amid COVID-19. And suddenly what you have seen, for example, in the case of Chile, that money base in 2020 increased about 20% of GDP. So the numbers quite similar to advanced economies. And in general, what you have seen is that these countries, with the gaining credibility from the 1990s and early 2000s, is that now they are trying to use more monetary policy to reduce the collapse of the economy. I don't think that they are going to revert nearly soon. As you know, there are the extent of social conflicts in Latin America is quite dramatic. We have a world in which poverty is quite dramatic. So I don't see reverting now. And although some countries have increased a little bit interest rates, I think that this episode will continue trying to recover the economy. So yeah, I think that we are going to see a little bit more easing in those countries too.
Thank you. Thanks, Graciela. We have another question for you, which comes from Maria, who is another LSE alumni. So Graciela is asking a little bit about Brazil in the 1980s, and she's asking whether you see any insight from the Plano Real as a solution to the economic crisis in Brazil in that period, and whether you think something can be done again in sort of a similar extension to Brazil and other countries in Latin America with similar conditions of higher inflation and increasing interest rates?
During that period, the situation in Brazil was completely different from here because the country was amid hyperinflation and they had to reduce that hyperinflation. The plans were introduced and inflation was reduced, but even in 1998, in 1999, there was a sharp collapse in a currency crisis that led to a large depreciation of the real. Whether now they are going, that there was a very contractionary monetary policy at that time and fiscal spending decline. I think that now with, well, of course, monetary policy is not at the levels that we have seen before, but still I think that the central bank is not going to tighten. Inflation is still in the lower double digits. I don't think that they are going to tighten quite dramatic right now. It's a real, the economic problem and the distributionary problem in Brazil is quite important.
Thanks. Thanks. So
I would note that I have a different take on that, but okay.
Go ahead, Carmen. Go ahead, Carmen.
Look, I mean, they already did the biggest rate hike since 2000, Brazil, and they're already pricing in, you know, further rate hikes. I think they're walking a very difficult line because inflation is manifested itself importantly through food price inflation. Food price inflation is even bigger than the headline double-digit inflation. This also has very big impacts on social consequences. So I agree with everything Graciela said about the fragility of the recovery and that this is a big concern. But at the same time, I think the many central banks are concerned about the inflation / currency depreciation dimension. And let's not forget that a lot of the inflation, as I said, is extremely regressive. You know, big surges in food prices were behind the Arab Spring. So let me just stop there.
Thanks. So I have two questions now, which are related and which are about comparing today's situation with previous pandemics that we have experienced in history, right? So Olivier Volkant, who is a professor at the LSE, and Joachim Liese, who is an alumni and a member of our advisory board, are asking whether there are any parallels we can draw, and more specifically, is it possible to draw any conclusion regarding international public finance in connection with the Spanish flu period during and following World War I? So do you have any thoughts on that parallel with the Spanish flu?
In March of last year, I wrote a project syndicate piece called "This Time Truly Is Different," and it wasn't a pun, or it wasn't. And I alluded to the Spanish flu, the influenza of 1918. The year that deaths in the Spanish flu peaked in the US was actually a boom year in terms of GDP. So this was importantly because the point I'm making is that the Spanish influenza was really dominated also by what was going on with World War I. So actually drawing comparisons on the macro side, on the fiscal or on the monetary policy response, it's not, first of all, you know, the big policy drive in not just the US, but in the both sides of the World War I conflict was, you know, increased production, you know, war drive. It's a sea change from what we've seen. Now, there is what I think very important legacies that sadly we will be going through. The pandemic, especially, you know, not exclusively, but India was ravished by the 2018 pandemic. The consequence was also very, very big impact on demographics, on birth rates, on all kinds of social markers. We at the bank, we're very cognizant that poverty has taken the first spike in 2020 since 1998. More than 2 decades, global poverty rates have increased. And one of the legacies of the pandemic of the Spanish influenza was, you know, also setbacks to development. And as I said, that was fairly dramatic in the case of India, but it was, and I am very concerned that those setbacks to those reversals, those which are hitting education, nutrition, you know, that is a big legacy. So, but just to note that I didn't draw more attention to the fiscal monetary debt side because it's impossible to look at 1918, 1919 without really it being dominated by what was going on with World War I.
Thanks. Well, I also have a question from one of our current master students who is asking a little bit about modern monetary theory, and especially the views expressed by Stephanie Carlton recently, right? So, you know, of course, when we talk about public deficits and inflation issues, that work has been very influential in certain circles. So it would be interesting to hear your thoughts about that theory, right? So if you have, you know, any thoughts to share about modern monetary theory.
Olivier, just to be clear, are you directing that to me or to Graciela or both?
To both of you, right? If you want Graciela, you can go first, and then Carmen. Oh, I think you're muted, Graciela. You need to unmute yourself.
Sorry, I was trying to hear. I don't know. I couldn't hear very well. Carmen, can you start and I can continue because I'm not sure the question. Okay.
So look, I think, you know, this is a question on modern monetary theory and the issue of inflation. Let me start by sort of offering some of my thoughts on monetary policy and inflation. During, and I alluded to this in my remarks earlier, 2008, 2009, during that so-called global financial crisis, even though it wasn't global, it was really about a dozen European economies in the US and so on. The policy response, a lot of central bank easing, quantitative easing, ballooning of monetary base and so on, and yet no inflation on a sustained or a little bit on a temporary, but on a sustained basis, nothing, no issues followed. So I think this built up a confidence that certainly you can have very large scale monetary expansion without it having the monetary expansion having inflation consequences. And the COVID monetary expansion was even greater than 2008, 2009. So are we going to have modern monetary theory would come out probably more along the lines of inflation from the monetary expansion should not ensue. But that's probably an oversimplification. But importantly, one thing we have now that we didn't have then is supply shocks. 2008, 2009, and its aftermath was dominated by a crash in aggregate demand. We now have also a big decline, historic decline in 2020 in aggregate demand, but we've also had a variety of supply shocks. This is reflected in transport costs that have soared. It's reflected in shortages of a variety of items. There's disruptions of standard supply chains, a mismatch between where workers want to work and where they are needed. There's all kinds of disruptions associated with COVID globally, not just in one or two countries, but really globally. Do not underestimate the impact of supply shocks on inflation. And central bank policy accommodation in the 70s did think that they could accommodate supply shocks. Back then, it was a simpler supply shock. It was OPEC. And the outcome was higher inflation. So I do not think that we should take the acceleration in inflation lightly. And for some time, well before many of the central banks have revised their view, I was arguing that inflation could very well be persistent because of also these important supply side effects.
Thanks. This is becoming too interesting, and we have many questions in the chat that I will not be able to communicate. I think we have 1 minute left. So I would like to use it to ask you a final question, which is a more general one about the usefulness of financial history, right? So I wanted to ask you both, in what ways you think financial history is useful? So Carmen, maybe one sentence here before we end it.
Look, I think financial history is very important for putting current environment in perspective. Don't always look for the identical, but perspective is important. I think there's a real tendency to think that every time we've rediscovered penicillin. And so, hopefully, and this is a hopeful statement, I think financial history awareness and economic history awareness in general helps you reduce the odds that many mistakes of the past will be repeated, even in slightly different form.
Thanks. Thank you so much. Well, thank you thank you the three of you for your fantastic remarks and presentations. We really enjoyed it. unfortunately, we have to end it here because I would have loved to continue the discussion for another 2 hours, but we need to stop here, right? So thanks to all of you, thanks to the participants, thanks to the audience, and especially to those students and alumni who ask questions here. So I'm gonna end the event now, and let's hope that the prospect for public debts will be not too negative over the coming years, and that we can use insights from history to address the policy challenges. Thank you so much. Bye bye.